Good evening and welcome to The Insight tonight. My name is Eugene Kwach, and of course you're watching The Insight. This is GBS TV. Tonight we take a deep dive into the Finance Bill 2024. Of course there's much more in the Finance Bill Act that we're going to get to look deeply into through the eyes of Peter Mwanja, who is a managing partner and head of tax and corporate finance at Ronalds Africa. Thank you so much for joining us for this conversation. You can also, of course, follow us through to the 144. That is our SMS line at GBS TV Africa, at Kwach Official. That is where you get to converse with us. And of course, we understand the conversations around the Finance Bill 2024. Notable issues, of course, that actually people are conversing around. And those are some of the things that we're going to delve into tonight, even as we start this conversation. Well, thank you so much, Mr. Peter, for joining us for this conversation.
Thank you. Thank you for having me.
Yes. How's the week been, sir?
The week has been good. Of course, a lot of activities with the finance bill and the budget estimates. So really been a busy one. Yeah.
Okay. The conversation begins right away, and I would like you maybe to tell us, even as we delve into this conversation, maybe tell us maybe the notable or the most significant issues that have actually can be picked from this finance bill.
All right. So, of course, the finance bill has had far-reaching changes in terms of our legal and tax regulations. And of course, maybe for purposes of our viewers, maybe we are going to finance bill and they perhaps don't know what finance bill is. So I'd like to start there and mention that a finance bill typically is an annual document that is published by the Ministry of Finance or Treasury, and essentially tries to propose various tax changes that will help the government in realizing their budgetary sort of targets in terms of revenue collection. And of course, over a period of time, you've seen that every year the budget keep increasing. I think the last year it was about 3.6 trillion. Currently we're talking about 3.9 trillion. So of course, when there's such a significant increment, there's always a question of where will this money come from. And that's why it's important that some of the tax laws be amended or be realigned so that the government has an opportunity and is able to even expand the tax base to cater for those budgetary considerations. Of course, this Finance Bill 2024 has seen many changes across different tax heads or tax obligations. Most notably is the issue of motor vehicle circulation tax, which I know is going to become a very heated topic for debate in the public sector. There's also introduction of VAT on some of these basic commodities. Most talked about is the issue of bread, which we all have for breakfast. So that has always been exempt, and now there's a proposal to sort of charge VAT on the same. But then most importantly, in my opinion, is the proposed VAT on financial services. So especially the financial services offered by the commercial banks. And we've seen most of the time when you transact, when you perhaps deposit a check, when you get your salary perhaps, there's always some charges that are deducted. So in this Finance Bill 2024, the government is trying to say, on top of the excess duty that you pay on these financial transactions, you also need to pay VAT on the same. So to me, that's a very significant sort of change, because it's going to make the cost of financial transactions and the cost of even doing business in the country very much expensive. And Eugene, you understand that our population, I think we talk about 40% of our population being unbanked, meaning these are people who don't have a bank account. So when you have such a huge population of people who don't have bank accounts, and you go ahead and make now transacting through the banks much more expensive, you're almost even pushing people who are within the formal banking system to actually now start transacting outside it. Yeah, because of course, when something becomes too expensive and affordable, you can always bet that people will try to find alternatives on the same. So to me, those are some of the most significant issues, and the most outstanding, as I said, is the issue of financial transactions being brought to the ambit of VAT. Having said that, there are also a few good things about the bill. I know it's the nature of us as Kenyans to always focus on the negatives, but I believe there are still some good positive things about the bill.
Okay,
thank you.
Thank you so much. I believe we'll get to delve into the nitty-gritties and the details of the finance bill.
Yeah.
But let's begin here. We had a finance bill in 2023, and now we have a proposal in 2024. What could be the difference? Maybe someone will ask, what is the difference? We now talking about 3.9. Initially, last year it was 3.6. What is the difference, apart from even just the figures? Yeah. What could be the difference that actually we now have, what you're now talking about, the notable differences, significant changes about the financial services, the bread, and all these things. Now, what do you think?
Yeah, I think the main difference is, or rather in any two sets of finance bills, is the difference is mostly the nature and extent of the proposals. The finance bill of 2023, in the history of this country, I think it was the most talked about, the most discussed about, and essentially it was because of the affordable housing levy that had been proposed in that bill. And I think we also saw a lot of litigations that came about, and even it went to court, and the court said, you know, public participation was not properly done, and therefore was thrown out. But of course, we've also seen the government try to bring it back through a different piece of legislation. So essentially, the main difference between perhaps the Finance Bill 2023 and the Finance Bill 2024 is the content in terms of the proposed changes. Whereas the bill of 2023 perhaps introduced affordable housing levy, you'll find that we don't have the same thing in 2024. But then there are also other changes that have been introduced, very new changes. The way we are talking about motor vehicle circulation tax that was not there before. Yeah, so essentially the main difference between those two sets of bills is the contents and the extensive or the extension in terms of the proposed changes.
Okay.
Yeah.
When you talk about 2023 having the housing levy and 2024 does not have anything like housing levy, what do you mean? Do you mean that 2024 going onwards, there'll be no levy there'll be no tax for houses? Or what do you mean?
Not really. As I said, this is an annual legislation, and it will always propose certain changes to the law. And of course, once you make changes to the law, it becomes now effective from that time going forward. So we might not need to every year introduce, let's say, the housing levy, because once it's introduced and it's made part of our laws, then we don't need perhaps any other legislation on that bit. But of course, as I said, the current bill has also its own set of new tax proposals. It has its own considerations and things that it has tried to put into perspective.
Yes.
As we said earlier, there are positives about it. There are also things that are really, for lack of a better word, very unreasonable and things that should not be in any piece of our laws, given our status as a country. So it's quite varied, and it's quite hard to actually say or compare the two sets of the documents without going to the nitty-gritties of the specific proposals.
But maybe let me just ask you as an economist, what always informs new tax rates? When you talk about introduction of maybe some tax rates into the law, what informs this? Maybe do they just sit somewhere and say, no, we just want to increase them, or are there maybe some economical situations that actually lead to us having, or maybe the government now introducing these new tax rates?
That's a very good question, Eugene. And most of the time, when there's a finance bill, the finance bill goes hand in hand with budget estimates. And I think that's always the sort of the point where we always miss it, or rather we don't connect the whole picture. Because on one hand, the government is saying we want to spend a certain specific amount of money in the annual budget. And you cannot look at the budget in isolation. the budget needs to be read together with the bill, because it's the finance bill that now says, in as much as we want to spend this much, then we must also be guided to know where will that revenue come from. And one of the major sources of revenue as a country or as a democracy, like any other, is actually taxes. And that's why it becomes then very important that when we have budget estimates that provide for a certain level of spending, then we must also have a way that will sort of raise that revenue. And this is done through new taxation, expansion of the existing taxation, and basically trying to have a lot of tweaks and introducing efficiencies into the existing tax laws so that that objective can be met. So the laws, I would say to some extent, are guided by how much do we want to grow our economy and how much does the government want to spend. If, for instance, the government was to reduce its annual budget for any given reason, then it might not be very necessary for them to introduce new taxes, because it will then be assumed that the existing taxes can raise that revenue that the government wants to want to spend. Yeah, so it's a consideration. It's something that goes hand in hand with the level of economic activity that the government wants to spur. And other than raising revenues, Eugene, taxes also play a part in terms of trying to discourage behaviors or consumption of certain commodities. So we might not even be seeking to raise revenue really, but we might say, for instance, there's a sector that has emerged in the economy that is harmful to the economy. And I can just give an example, like, the betting industry, which people will consider to be, a bad or an unethical behavior that has really got into the society. So what the government will then do to discourage that is to say, now we want to make betting more expensive so that fewer and fewer people will participate. And how will they do that? By introducing taxes in that particular industry. So really the tax proposals are dependent on what the government of the day wants to achieve, whether it's revenue, raising revenue, or essentially maybe discouraging certain sectors or trying to discourage consumption of certain services and goods.
Thank you so much for actually elucidating on that, because when you talk about taxes being increased to maybe discourage consumption of certain goods, someone will wonder whether the government is discouraging maybe using of bread. But there is a conversation for, we're going to delve into that conversation. Generally, I would wish to ask, it could be a political question, but this government, as we know it got into the government through the conversations around the previous regime had actually raised taxes on petroleum, on basic commodities. And they actually say that when they get in, things will be quite different. That the common mwananchi, the hoi polloi, will not be burdened as they're being burdened right now. What do you think, are there some measures that the government has actually placed that as an economist you can say that actually this government in 1 or 2 years is actually, we are going to see these taxes reduced, or will they continue increasing?
That's also a very good question, Eugene. And you're right. When the current government came into office, or when they were in the campaign mode, when they were campaigning to be elected, I think they were very vocal about the issue of taxation. They were also very vocal about uplifting the low-income earners. They like to call them the hustlers. And they were saying this is a hustler government that is sort of focused on the common mwananchi and the low-income earners, as I said. But when you look at the policies and some of the proposals that they have, enacted over time, it sort of begs the question whether really they were intentional about that. For instance, in the current bill, we have always said that, for instance, for withholding taxes, if you are earning less than 24,000 in a month, then you should not be subjected to withholding tax. But now in the current bill, they're saying we want to do away with that minimum threshold, meaning that whether you work, you offer a small consultancy somewhere, you even paid 1,000 shillings, it's like they're saying that has also to be subjected to taxation. And therefore it's sort of an ironical situation in the sense that the leaders who came into office promising to reduce the burden for the common mwananchi seems to have forgotten that agenda. And I know it's really a political question, but we tend to think that they are not very intentional. It's like they are speaking with both sides of their mouth when they say that this is a hustler government, or the economy needs to focus on the low-income earners, or else at the same time really bringing a lot of taxation and a lot of new regulatory requirements to people who are actually low-income earners. So we cannot relate between the leaders when they are campaigning and now the leaders when they are in office.
Okay.
Yes.
Interesting. Well, on the government's decision to increase VAT on basic commodities now like bread, what would inform the government to actually increase VAT, actually introduce VAT in basic commodities like bread?
I would think that mostly it's revenue collection, or trying to raise revenue. Because, of course, our VAT Act has a schedule. We normally say it's the first schedule that says what items are exempt, meaning that they should be sold without VAT. And I think since this government came into office, we've been seeing that list of exempt items reduced every single year. And that's why currently we are saying a basic commodity like bread, they're proposing that people need to start paying VAT on the same. So there is no justification, and I would think that the only reason they can give is that they want to target that as a revenue collection measure. Of course, when you have fewer exempt items, it means Kenyans will be paying more VAT, in different sectors, and therefore the government will collect much more. So to me, it's a revenue collection initiative. Which is to a big extent misguided, because there are some items and some commodities that you avoid heavy taxation due to the fact that when you do that, you increase the cost of living. And bread, Eugene, some people might argue is a privilege. But we all have to agree that it's that common and basic commodity that each family deserves to have for breakfast. And when you make it more expensive, it sort of beats the purpose. And these low-income earners, who perhaps are the biggest buyers, might start finding it a bit unaffordable.
Okay, thank you so much. Well, as we talk about the finance bill itself, you had earlier mentioned that, of course, we have people losing. But we also have in this conversation the finance bill, some who are actually winning. Maybe you could just elaborate specifically who loses in this finance bill and actually who is gaining or who is winning.
So it's really hard to tell, Eugene. But if I can start with the positive side of things, we've seen employees get new incentives. For instance, when you pay for pension, or you contribute to pension, there is normally a tax deduction that you get, which is normally up to the limit of around 240,000 every year. So currently, the government has proposed to increase that deductible pension contribution to about 360,000. So it's sort of encouraging people to save at the same time getting tax incentives. So it's a very positive thing. Also, we have seen the mortgage interest. For instance, Eugene, if you decide to buy a house and you take up a mortgage to do so, you of course be repaying that, and you'll pay mortgage interest, and that has always been a tax deductible expenditure as well. And there was a cap or a maximum limit within which you'll get a deduction, which was about 300,000, and now they have increased it to 360,000. So meaning that you sort of take advantage, or you have a more significant amount for you to benefit from the tax deduction. However, on the flip side, we have to agree that interest rates have risen sharply over the last couple of months. So in as much as that is an incentive on one hand, it might be sort of crowded out, or the effect might be wiped out by the high interest rates that we've also experienced in the last couple of months. But you would think that compared to last year, employees are really favored by this current finance bill because there are quite a number of good proposals on that line. Per diems, for instance, for working out of town, employees have always been subjected to a maximum of 2,000 shillings per person per day, meaning that when you go and work, let's say in out of town, you will get compensation of about 2,000 per person per day without having to suffer taxation. But of course, you know, in the existing economic circumstances, the 2,000 per person per day is quite on the lower side. But then positively about the bill, they have proposed to increase the amount to about 5% of the gross pay of that person. So it's sort of very positive when you look at it from an employee's perspective. However, on the negative side, I think there are some proposals, especially to the business owners. There are a lot of proposals that seems to really be against or that seems to discourage people from doing business. And I'll give an example. If you are a company and let's say you're in the fast-moving consumer goods and you need perhaps 10, 20 trucks to deliver commodities to your customers. When the government comes in and says that you must pay motor vehicle circulation tax at the rate of 2.5% of the insured value, you are simply telling that business owner that over and above the high fuel costs, over and above the high insurance amount that you need to pay on an annual basis, over and above the high maintenance cost for those vehicles, you now need to also be paying taxes for those vehicles. So you see, it's a bit of a dilemma, or rather a bit of a sort of a strange proposal, because our laws are, or rather our Income Tax Act tends to subject income to taxation. But in this case, you are subjecting property or what we call wealth to taxation, because owning a vehicle does not automatically mean that you'll make any income out of it. So those are some of the things that when you look at them from a critical perspective and from a business owner's perspective, they are sort of making the country very unattractive to businesses and to business owners. And the investors that we are trying heavily to bring might prefer going to other jurisdictions. Yeah.
Thank you so much. We're taking a very quick short break, but of course we'll be right back now as we get to the intricate part of it, as we get to delve into the bit of it on these taxation rates, and of course as we get to understand more. Thank you so much for joining us. Of course, we are here on the Insight as we get to unpack the Finance Bill 2024. We have Peter Mwanja, Managing Partner at Ronald's Africa, and of course this conversation continues shortly.
12 commandments of cancer prevention.
When you look at it realistically, it's something that starts from within you, from your own cells. So all of us, as we are seated here, some cancer cells are forming, but we have a secret service in the body which is more efficient if you have had enough sleep, or if you have exercised, or if you are having enough fruit and vegetables to mop up the radicals. That secret service is called the natural killer cells. They are always killing the cells so that they don't develop in full-blown cancer.
Basic and simple things that we all know, but apparently we don't practice.
We're having a big problem because this country soon will have no human beings.
When you hear about cancer, sometimes you think it's the end of the world.
You are overthinking, you get? So you're secreting a lot of stress hormones. So why can't you relax? Or maybe just remove your shoes and walk bare feet.
This is Art Club, where you can find us every Friday at GBS TV.
Grew up in a school where they believe since you're slim, you're fit to be an hostess. Along the way, I dated into this family where one of their brothers looked down on me because they were a pilot, and they knew I wanted to be a pilot. And since I come from a humble background, I've been raised in Kibera.
Looking at your Instagram account, girl, you're just out there. Like every day you have something new to show us, and you're very outstanding.
And everyone right now, everyone is doing content. What people don't know is it's it is a competitive industry, but there's space for everyone.
Yeah.
There are just people God will send to help you along the way. You just have to be assertive with yourself and what you want, and just go there and believe, like, if it's a calling, if God has called you to do this, He will make a way. Like right now I'm just moving, like, I don't know when my next partnership is, but I know God will make a way. My content has been embraced so well out there, so najimotivate, like, you know what, as long as I've done my part, God will do the rest.
We are your home of entertainment, education, and everything all about art. Be safe, both gender, man and a woman, they have the right to be safe and not to be taken advantage of.
The 12 commandments of cancer prevention.
When you look at it realistically, it's something that starts from within you, from your own cells. So all of us, as we are seated here, some cancer cells are forming, but we have a secret service in the body which is more efficient if you have had enough sleep, or if you have exercised, or if you are having enough fruit and vegetables to mop up the radicals. That secret service is called the natural killer cells. They are always killing the cells so that they don't develop in full-blown cancer.
Basic and simple things that we all know, but apparently we don't practice.
We're having a big problem because this country soon will have no human beings.
When you hear about cancer, sometimes you think it's the end of the world.
You are overthinking, you get? So you're secreting a lot of stress hormones. So why can't you relax? Or maybe just remove your shoes and walk bare feet.
Everywhere, GBS.
Thank you so much and welcome to The Insight. Of course, we continue with this conversation with Peter Mwanja and on the Finance Bill 2024 that was introduced to the Parliament. Well, Mr. Mwanja, as we continue this conversation, the conversation that led, that marred the 2023 Finance Bill and actually was quite contentious was the one on housing levy. Well, about this year, do we have something that is quite contentious or brings controversy, or that could actually mar such controversy, even as you continue in with the conversation on the Finance Bill 2024?
Yeah, thank you, Eugene. You're right. The Finance Bill 2023 had some provisions that became very heated and became the subject of numerous litigations and court cases, and that was the housing levy bit. And currently, when I look at this Finance Bill of 2024, it also has a lot of provisions that they are quite unbelievable, to be honest and to be candid with you. For instance, the issue of motor vehicle circulation tax that I keep talking about is something that we never foresaw, a scenario whereby tax will be introduced on a property or a wealth that you own as a taxpayer. But then, most importantly, there are other provisions that seems to almost limit the rights and obligations, or sort of the constitutional rights that have been given to Kenyans by the Kenyan Constitution. Some of these provisions seems to want to limit that. For instance, when you look at the Tax Procedures Act changes, you find that there are some elements inside there that seems to give the taxman so much powers as compared to what ordinarily should be.
Yes. Now let's talk about the motor vehicle tax implementation generally. Yeah. Because you've talked about it so much, and maybe it could be quite contentious. Someone will maybe just wonder, what are some of the implications, maybe not just to the people that own the vehicles, but even to now the automotive market in Kenya generally. Yeah. Does it have, or do we foresee any impact?
Most definitely, especially when we go to the insurance sector. Remember, we still have a lot of challenges with the penetration of insurance products in the country, whereby you find that given where we are as a country. The penetration of insurance and insurance services is quite very low. And when you introduce a tax that says when you're paying for insurance, that you also need to pay this tax, you are simply trying to discourage even the penetration or further penetration of those insurance services. And you know, it really has a ripple effect in the economy, because if, for instance, I find that it's too expensive for me to insure my motor vehicle comprehensively, I'll opt for third-party insurance. And it means that whenever there is loss, I'm not able to be compensated. So if that is a vehicle that I use for my business, then every time there are issues with it, it means that my business will come to a halt. So there are a lot of such implications. And of course, it means that me and you might find now owning a car to be very expensive. And whenever that happens, it means that we'll stop buying vehicles, or we'll park the vehicles that we have at home. It means less consumption of fuel and the related. And ultimately, we can have an instance whereby that tax has led to actually a decrease in taxation, or a rather collection of other taxes. For instance, if fewer people drive their vehicles to work, it means that, you know, the fuel levy that we pay, the VAT that we pay on fuel, will also keep reducing. So, and we normally say, as a concept in taxation and economics, that sometimes tax can actually eat tax, meaning that one tax might contribute to the reduction of collection of the other. So those are some of the changes and some of the effects that we are going to see, but of course, there are much more than that.
Thank you. I think another conversation is now the talk of the introduction of eco-levy tax. And as we know, the government has been very intentional, or as we have seen it actually, even through introduction of holidays specifically to plant trees. It means that it is pro environmental sustainability. And when we talk about the introduction of eco-levy tax, maybe a big question that it begs is that how does it now promote environmental sustainability?
Well, Eugene, the climate change has become one of the most important issues in the globe at the moment. We've seen a lot of pollution, we've seen a lot of changes in global warming. Recently in Kenya, we've also experienced extreme weather, you know, the floods, the heavy rains, sometimes also the drought. When it comes, it becomes very, you know, aggressive. And all these are effects of climate change. So any tax proposal that seem to address some of those challenges will obviously be a very welcome move. However, we have to be very careful on how we do this. Because when you look at the eco-levy, some of the proposals and some of the taxes that have been introduced seems to almost discourage or kill industries as a whole. And I'll give an example with the levy on paper bags. There are sectors in the economy that, you know, do packaging materials, and some of those packaging materials, when you look at the price per kilogram compared to the eco-levy per kilogram as proposed, you find that the levy is actually more than the cost of those materials. So it means that such an industry might find itself in a situation whereby they are not able to continue existing because what do you do when the tax is actually more than the revenue that you're generating? So it's a good move, yes, but we have to be very careful on how we implement it so that we avoid killing certain sectors, or else we are trying to sort of safeguard our environment.
Another thing that actually we can talk about is that is quite significant is now when we talk about the VAT registration. That is, of course, the threshold has been actually increased from 5 million to 8 million. So there could be expected benefits and challenges to this. But generally, maybe someone will ask, how impactful is it now to the small, medium enterprises?
Thank you for that, Eugene. I think this is one of the good things about this finance bill for 2024. And as you said, we have a growing SME sectors which over the last couple of years have been burdened by a lot of tax compliance obligations and a lot of, heavy taxation. So the move by the government to actually increase the VAT registration threshold from 5 million to 8 million is a step in the right direction, because we are saying that you as a small business owner, you don't have to be worried so much about heavy taxation or a lot of tax compliance burden when you're still small. So you're given sort of room to get your house in order, grow your business, and then from there you can start adhering to VAT. So it's a step to the right, or rather towards the right direction, and it's quite encouraging to see that the president and his government at large is really concerned about small business owners. So we anticipate that this will try and give these small businesses some bit of relief in the sense that they will not be subjected to too much taxation. They only need perhaps to comply to, let's say, the turnover tax if they are within that threshold, without worrying too much about VAT.
Interesting. Let's talk about the digital service tax. I was wondering whether it's impactful to the economy when, of course, it is being introduced. I don't know what you think as an economist or generally as an expert in this. Now the conversations around the digital service tax.
Jean, the whole concept about digital services tax was a very noble concept. And it was coming from the perspective that we have big multinationals or big players like Google, Facebook, and other such corporations who are operating in the country remotely, of course, without physical presence. They earn revenue from this country, and they take that revenue to their home countries without having to pay local taxes. So when we said, let these guys also contribute their fair share to the economy, that was a brilliant move, and it was quite reasonable by all means. But of course, you've seen the digital services tax regulations sort of evolve over time since when they were introduced in 2019 and to when they were effectively implemented in 2021. So there has been a lot of changes, and we are seeing that now the government has sort of taken a U-turn from DST and want now to replace it with what they're calling significant economic presence tax at the effective rate of 6%. So which essentially tends to almost apply the same way as DST, but with a bigger tax rate or with an expected, more tax burden to some of these big players. And while it's a good move to try and collect revenue from these corporations, we also have to be very careful so that we don't chase them away. We don't try to tell them, hey, our tax structure is too complex or too expensive, and they think that we don't have to do business in Kenya. We can go to Ethiopia in the neighboring country. We can go to Uganda or the bigger East African region. So it's really a very delicate balancing act that the government has to play, because whilst it's noble and a good thing to try and get them to pay taxes, we must also try and balance so that we don't put it in a way that will actually chase them away. Because we are living in a very competitive world. What we are providing as Kenya, someone perhaps can get it in Uganda. They can get it in Tanzania. So it's always about what is the competitive edge between one economy and the other. And some of these investors, they are well informed. They know which country has the best tax policies, and they'll always choose to set up their operations in that jurisdiction that is most, it's giving them most incentives.
Thank you so much. Well, just before, as we continue, maybe someone will ask, why 6%? Why not 7%? Why not 5%? And there are, what informs these figures, even the percentages?
I think when I talked about the 6%, actually it's just an effective rate because we did some calculations and we realized that they said that, for a company, for a company that says is operating digitally and it's an unresident company, they're saying that 20% of its revenue will be considered to be revenue generated in Kenya or revenue subject to tax in Kenya, and that 20% is to be subjected to 30% tax. So that's how he arriving at the 6% rate. For sure, we can't really say what was the calculations or what was in the thought or in the minds of the people who came up with the rate, but I would sort of assume that they sat down and realized if you want to make as much money as possible from these guys, perhaps the rate has to be significantly higher. But of course, they were also trying to do so in a controlled way so that it doesn't become too expensive. So there must be statistics behind, of course. Remember, we have a very able institution, the Kenya National Bureau of Statistics, that keeps records of all our statistics. So they could perhaps have done some bit of data evaluation and realize that, you know, these companies, these multinationals that we're talking about are generating X amount of money from the economy, and they thought if we do 6%, then we'll be getting a fair share of the same.
Okay, thank you so much. You talked about tax policies, and actually some of these multinational companies, they look at and actually know, they have data of which country has got best tax policy compared to the other. And this will actually mean that countries differ in terms of tax policies. So it will actually beg a very critical question that what informs the tax policy, or rather the structure of taxation in a country? You talked about the budget. Are there other institutions or maybe other things that actually inform tax policies? Maybe if I could just ask directly, we have like the Bretton Woods institution that actually lend us money sometimes. So they also always come with certain conditions before we get this money. Could they also be potentially the reasons why some tax policies in some countries are in a certain way and compared to some other countries?
You're right. You're very much right, Eugene. In fact, we've been observing that some of the tax proposals that we have gone through in the last couple of days or years, they seem to have an outside hand from some of these institutions that you mentioned. Because when we approach those institutions seeking to borrow from them, they give their hand or their assistance with conditions. Perhaps they say, before we lend to you, you have to achieve a certain threshold in terms of the amount of taxes that you generate from your revenues. And of course, when there are certain conditions, the government has now to sit back and really attempt to meet those conditions. If, for instance, they say, maybe you're collecting taxes equivalent, let's say, to 14% of your GDP, and they say, we'll only lend to you if you're able to achieve maybe taxes that are equivalent to 16% of your GDP. It means that the government has to try and introduce more taxes or more additional tax policies so that, you know, they can be able to achieve that and be able to benefit from those borrowings. Having said that, we also have what we call the National Tax Policy, and I think it's also been a document that has been widely discussed in the country in the last couple of years. And the National Tax Policy was effectively supposed to pronounce the government's attitude or the government's policy or the country's policy when it comes to taxation, so that there can be some bit of, you know, consistencies in the way we implement tax policies. There can also be some element of certainty, because you'll observe that, Eugene, some of the changes that have been brought about by the Finance Bill of 2024, for instance, the exemptions that have been scrapped, you will be surprised to realize that some of those exemptions had been introduced by the Finance Bill of 2023, which of course became the Finance Act of 2023. So meaning that less than 1 year after we got some of those proposals or some of those changes, we are now scrapping them off. And this is the problem, Eugene. As an investor, you might, as I said, investors have access to a lot of information, and they'll always try to weigh which country has the best tax policy. So if, and I'll give an example for the motor vehicle assembly plants. The government had said last year that if you're in that business and you are assembling motor vehicles locally, we are going to give you VAT exemptions. So you can imagine there are companies that came and decided that, you know, if we are getting VAT exemptions and we're in that industry, then that is a good incentive. It will make us more competitive. And perhaps they started plans for building those plants. But come the finance bill of 2024, the same exemption that had been given is now being proposed to be removed. So it begs the question, despite us having the national tax policy, what happens then? When we are, you know, having all these uncertainties? We have an introduction of this law this year, then a few months down the line, then you remove it. So it's a policy a flaw, or I would say it's a challenge that we're having as a country, which should have been addressed by the national tax policy, but we don't seem to be there yet.
Thank you. We're still talking about tax policy and maybe what could inform some tax policy, national tax policy as it may. We have had the president very intentional, I don't know whether intentional is the right term, but on living within our means, on borrowing, as we had mentioned, based on institutions, because actually they impact a lot on maybe some of these policies that we have. But looking at the Finance Bill 2024, do you think that it's very deliberate, the president is quite deliberate in the bill, maybe from some of these proposals? Can we say that now the president, through this bill, the president is indeed very deliberate that we should live within our means, when even he proposes to some government workers to assist us live within our means? What do you think?
So that's a very subjective question, Eugene. But you'll agree with me that you know, living within our means is mostly from the expenditure perspective, saying that, you know, we are spending depending on our ability to spend. And the controversy in this scenario is that the same government that is saying that we need to live within our means are also spending excessively on things that are non-essential. We've seen a lot of, you know, budgetary allocations to some of these big offices, and I want to name them. But it begs the question, why are we saying we need to limit our spending, whereas the leaders, the president and the deputy president and the bigger sort of leaders in the country are allocating themselves huge budgetary allocations. And when you look at the finance bill from a living within our means perspective, it tends to introduce more and more taxes to the low-income earners. So I have never seen a country that has ever taxed itself into prosperity. So we seem to be taxing ourselves with the hope that will change the course of this country. And quite contrarily, we are likely to achieve the opposite, because when businesses feel too burdened, people will say, okay, you know, enough with the business, I have to go and rethink about it. And of course, we end up not growing as fast or expanding our economy as much as we would want. So there is no correlation between what the president is saying and what we are seeing in terms of the tax proposal, for lack of a better word.
Thank you so much. I want us to, let me just ask you this. The other time that you were here, we talked about e-TIMS in tax compliance generally, and how it's being used by actually the government in maybe to ensure a sustainable tax compliance. What do you think is the progress so far? The other time e-TIMS was quite trending. Maybe you can tell us from where you sit. Do you think that onboarding e-TIMS in tax compliance, has it been successful? And if not, what are some of the major issues and challenges still on even onboarding small businesses on e-TIMS?
And thank you for reminding me about the conversation. And if you remember, I was a very strong proponent of the e-TIMS. It's, as an idea, it's a very noble idea, because it sort of tries or attempts to bring everyone on the tax bracket. And of course, Eugene, you know that if all of us could be in the tax bracket, the burden that has always been attributable to a few will then be distributed to almost everyone, making it much easier and much more affordable to everyone. But when it comes to the implementation of eTIMS, there has been a lot of challenges with the same. And the major challenge is what we had discussed before, that we have a huge population or a huge a portion of our sector, of our economy, being the informal sector. These are people who don't have systems. These are people who do not keep books of accounts. These are people who have no ability to hire an accountant. These are the mamambogas, the carpenters, the common citizens that are running very small, tiny businesses. So when you wake up one day and say that you want to formalize, or you want to tell those guys to, put structures and accounting systems within their business within a very short time, it becomes very challenging because those people have no capacity to do so. So that has been the biggest challenge with eTIMS rollout. The other day we saw them say that, for instance, the VAT returns, you no longer need to, populate. Okay. They will be auto-populated based on how you're transacting with your customers and your other stakeholders. And I can tell you, it was a big problem. I mean, the whole country was in chaos because no one could be able to file their VAT returns, or no one had a proper VAT return that was reflecting the true position of the transactions. So it's a good idea, but as I had mentioned before, it needs to be rolled out perhaps in phases, whereby we start with a certain category of taxpayers, we move to probably slightly the bigger ones, until now we can bring everyone on board. Most notably, in this finance bill, they have proposed some very punitive penalties for failure to comply with eTIMS and to integrate your systems with eTIMS, a penalty of about 2 million shillings per month. So you can imagine, if you tell a small business owner that you're not TIMS compliant, or you have not integrated your systems with eTIMS, and now we want to charge you a penalty of 2 million shillings per month, becomes very unreasonable, and it's very hard, Eugene, to relate to. Because this is someone that perhaps they have never even seen the 2 million shillings for a whole year, assuming they are a small business owner. So it's quite difficult, and it's quite impractical for the government to give certain or such proposals. Yeah.
Thank you so much for your elaborate explanation of this. But of course, we are coming to the end of this conversation. Maybe someone will just ask your expert view on this finance bill. It's actually on the very, it's beginning, and it was being introduced to the parliament, and of course the several stages that it has to go for it now to become a law. Just maybe through your expert lenses, maybe what do you believe will be the end of this bill, just judging from even the ones that we've had before? Yes.
Yeah. So I mean, Eugene, we know this country. The government is saying these are proposals that will be discussed, and our view will be considered. But as we observed in the last bill, most of the proposals that were heavily contested still found themselves in the act, in the final version of the document. They were still enacted into law. So I don't expect any much change in terms of the bill as it is, because we've seen the government being very keen that whenever they put out a law, they marshal and ensure that they get all the numbers in parliament to make sure that it sails through. But most importantly, Eugene, there are some of the provisions, especially in the Tax Procedures Act, that seems to limit the rights of citizens. For instance, when you say that when you have a tax dispute with the taxman and you have appealed that tax dispute to the Tax Appeals Tribunal or even the High Court, but you also bring another proposal that says, despite that, KRA can still issue agency notices or can still attach your property or your bank account. What does that mean? Does it mean that you want to give the taxman sweeping powers to decide how much tax you need to pay and not even allow you to seek sort of justice in the legal system. Yeah, so some of those changes are quite retrogressive, and they are proposals that we should not be having in a modern society or as a sort of a democracy like ours. When you say that if you object to a tax decision and the taxman does not respond, and that is meant now to mean that your objection has been thrown out, you wonder, are you trying to make the tax authority to be the judge and the executioner? Because some of those things needs to be heard and they need to be deliberated so that there is sort of conversations around them. And if you're not satisfied, you can always seek justice or the intervention of our legal system. So that is, I think, my opinion on the same. And we hope some of these proposals will really not see the light of day.
Okay.
Yeah.
Your parting shots as we come to the end.
For me, Eugene, I think it's just to see how this will come out. I can tell Kenyans to brace for tougher times ahead. But I do believe that if we can push our lawmakers to actually speak on behalf of the citizens, then some of these changes in the powers that the government wants to give itself will then be controlled, and we'll have a more sustainable finance bill, and we'll even have a more flourishing economy going forward.
Thank you so much, Mr. Peter Mwanje, for your insightful deliberation of what the 2024 finance bill means, and actually what it portends, its impacts actually to the businesses and even to individuals. Thank you so much also for viewing, actually for being part of this conversation. As we continue with this conversation, we will still continue diagnosing and looking at how this story on the finance bill actually goes and what happens next. Of course, we will continue this conversation here on The Insight. On The Insight is where we get conversations around current affairs. We talk matters business, matters politics, and of course, we also get to delve deeply into matters policies, economy, and matters that affect you one-on-one, our viewer. Well, tonight we are done, and of course, we are grateful for you. And of course, on behalf of everyone else who has made this happen, we wish you a good night. My name is Eugene Kwach.